Most traders open GBPUSD, draw a few levels, add a few indicators and try to determine if it's bullish or bearish. The problem is that GBPUSD is not one thing. It's two different currencies pulling against each other. The pound can be strong, the USD can be weak, or both can be weak. Or the whole move could be coming from somewhere else entirely. So I want to show you the basic relationship map I use before I get into any setup. It starts with the US bond yields, interest rates, DXY, GBPUSD, EURUSD and EURGBP, and how I decide which pair makes the cleanest expansion. The simple version is that I'm using the DXY for analysis, and then I'm using either GBPUSD or EURUSD to best capture the move. If the dollar is strong, I want the weaker opposing currency. If the dollar is weak, I want the stronger opposing currency. And that's where I use EURGBP to determine which one that's going to be. The shift is to stop asking whether one chart is bullish or bearish in isolation. That question itself is too small. If pound dollar is moving up, there are at least three very different explanations. Pound is strong, dollar is weak, or both are moving, but one is moving faster than the other. They all look similar on the chart, but they do not mean the same thing. If the move is mainly dollar weakness, pound dollar and euro dollar may both be moving higher. If the move is sterling specific, pound dollar may be much stronger than euro dollar. If the move is messy, the chart might be trending, but the relationship picture is not clean enough for us to trade with any confidence. This is why cross-pair relationships are so important for developing both your higher time frame and your lower time frame bias. This is the simplified map. At the top you have the US bond yield, so you could be looking at the 5-year, 10-year, 30-year and the interest rate expectations. They are not the only thing that moves the dollar, but they are the main driver, so it's the first thing that you want to understand. If US yields are rising because the markets expect a tighter policy or stronger growth or a higher for longer rate path, that does support the dollar. If the yields are falling because rate expectations are being cut or growth is weakening, it can pressure the dollar. So once I know what's happening with the yields, I look at the DXY. The relationship is not perfect, but it gives a useful broad read on whether the dollar itself is being bought or sold. Then I go to the actual tradable charts, the pound dollar and the euro dollar. The key question is simple. Are these pairs moving together because of the dollar, or is one currency clearly stronger or weaker than the other? For this specific framework, pound dollar and euro dollar are not the main analysis charts. They're just what we use for the execution. All the analysis, like the fair value gaps, the order blocks, is all done on the DXY. I look at the EURGBP to help me decide which of the two dollar pairs, pound or euro, is going to be the one that I can trade. Because if you've traded both, you can see when the dollar moves, the price action on either the pound or the euro may be more muted or more pronounced. If the DXY is strong, I don't want to pair it with another strong currency if I can avoid it, because it makes the move slower and less pronounced, and you just can't capture as much pips. DXY is weak. I do not want to pair it against another weak currency. Basically, it's the same issue. The pair just kind of drifts rather than like having clean moves. So for intraday trading especially, I'm looking for that contrast. You need to pair strong against weak, not strong against strong or weak against weak. The first thing I want is not a precise economic forecast. I just want to know where the pressure is. Are the US yields rising, falling, or are they range bound? So I've got the 10-year yield here and the 30-year yield. You can see they're very similar. See on the 10-year bonds that this section here from about March, 27th of March, the yields were actually declining. If we look at the DXY in the same period, 27 March, look how we have the DXY declining as well. So if the yields are rising and DXY is also rising, from that we're looking at essentially where is the DXY heading. If we were looking at the 10 yield here that is starting to rise, we take a look at the DXY, and now we're going to frame our ideas of this. So you can see we've got fair value gap here, we've got this gap here, we've basically got further gaps to look at and to position ourselves better, because these are the likely areas that we are going to see specific forms of price action, either continuation or reversal, depending on whether the gap is respected or violated. Now, we're not looking to capture this whole entire move. Now, we're just looking, if you on the daily, just where the next candle is likely to head. Not specific levels, but whether it's going to close higher or close lower. The pound dollar and the euro dollar are inversely proportional to the DXY. So when the DXY is going up, it means pound dollar and euro dollar are heading lower. And if the DXY is heading down, it means pound dollar and euro dollar are heading higher. It's not perfect, but you get the general idea. For instance, here's the dollar, here's the DXY, euro USD, pound USD. It's almost like a mirror, right? Notice this low here and then moves higher. Euro dollar, we have the high here and then it moves lower. It's a very close inverse correlation. But looking specifically against the euro and the pound dollar, why do they look slightly different? This is what I'm going to head into in the next section. This is the part a lot of retail traders skip. So choosing between the pound dollar and the euro dollar, I'm not looking for which chart has the nicest looking setup, because remember, I'm trading the DXY. I'm asking which pair is going to give me the cleaner expansion of the underlying idea. Obviously, if the DXY is falling, pound dollar and euro dollar are going to trade higher, but which one is going to have the most pronounced move and is the least likely to just drift, like I mentioned earlier? This is where EURGBP comes in. If EURGBP is moving higher, it tells me that euro is outperforming the pound, and if DXY is weak at the same time, euro USD may be moving much better than pound USD. So because I'm pairing the weak currency or the weak dollar against the strong euro, vice versa as well. So if euro GBP is moving lower, pound is outperforming the euro, DXY is weak, pound dollar may be the cleaner move. The inverse applies when DXY is strong. The key idea is I'm not choosing GU or EU because the charts look better. I'm choosing the pair that helps me to best capture the DXY move. Strong paired with strong or weak paired with weak results in very slow price action. You get minimal movement. When you pair strong against weak, the move is a lot more explosive looking. You will see it genuinely just runs off, which is very important if you're trading intraday, because you want to be in and out within the same day. You don't have time to be waiting around, and if you're trading those lower time frame moves, you don't want to be caught in some kind of reversal on the higher time frame. So the framework is that you start with the yields, the bond yields and the interest rates for the macro pressure, and then you move down to the DXY. The DXY tends to move in correlation with the bond yields, not perfect one-to-one, but in general it does. And all the technical analysis is done here on the DXY. This is the thing that I'm essentially trading, but I get exposures to it through EU and GU. But DXY is what we're reading, it's what we're analysing, it's what we're mainly looking at and monitoring. Then we move down to EURGBP to decide whether to use GU and EU. We will pick either the weaker one or the stronger one to pair with a stronger or weaker dollar. So you want weak and strong paired, and not strong and not weak and weak, because that won't give you the fast movement, the high volatility. So once you filtered out euro or pound, then you move down to the pair, EU or GU, and this is where you're going to execute. You could use the same technical analysis, maybe not so much on the higher time frame. since you're basing it off the DXY move. But on the lower time frame, you can wait for like a fair value gap to get traded through cleanly, and that's your sign to enter on the next candle, something like that. You can base your take profits as well and your stop losses on the market structure of the EU or GU. Let's move on to the actual chart. So looking at the 10-year yields, mainly on the 10-year, you can see we've been stuck in this range since around March time, not really moving anywhere. There was a bit of expansion higher, but there's a lot of uncertainty with the Strait right now and with oil prices. 30-year slightly unclear as well. We've gapped lower here, so there's some kind of pressure, but overall I think it's difficult, but not to worry. We'll still take a look at the DXY. The DXY is quite clearly weak. We've got bearish market structure. There's bearish fair value gaps being respected, and then coming into here, there was a nice setup earlier this week on the Tuesday. It's not a hindsight trade. I'll run you through what you would have seen. But clearly we're seeing weakness in the DXY, so take note of that for when we get onto the EU and GU. There's this clear fair value gap here. We trade up into it on the Monday. We'd be watching on the Monday, but there's no actual setups given. So that leaves us to go into Tuesday, and we getting a potential bearish weekly profile with either Monday or Tuesday making the high. So when we see drop down to a lower time frame, when we see Monday's high getting swept, Tuesday's Asian high getting swept, and then we see this on the 15-minute, the structure shift lower, and this is also a bearish breaker block because it goes there's a higher high and a lower low, and then we can mark this out, anchor our fib to it, and then essentially wait for my trading setup. Yours could be completely different. This is just an example. But we have the New York Open here, and we trade up into the OTE, 7.5 OTE level. Stop loss at the high and then take profit at the low. This is the minimum take profit right here. And then potentially targeting this low here. But fear of the fair value gap, I'd be more cautious for an intraday trade. But if you're going on to, I keep doing that. If you're looking at it from a high time frame perspective, you can see we start taking low after low after low after low, continuing the higher time frame bearish market structure. So that's the idea. We're bearish on the DXY. What we now need to look at, since DXY is weak, we need to look at EURGBP and see which is the stronger pair out of euro or pound. You can see bearish again. Lows are being taken out and bearish fair value gaps are being respected. Nice wick away, and then Monday here, wick away. So it's quite clear that we are heading lower, so that means the pound is stronger. So which pair are we going to pick? Dollar is weak, pound is strong. It means euro is weak, so weak and a weak is something you don't want. Weak and a strong is what you want. It's going to be pound dollar. The market structure here, you can see we have this high getting swept. So higher low, higher low, higher low, higher high, higher high. Whereas on euro, lower low, euro, lower low, and lower high. So you can see the difference. Here we're making higher highs. Here we're making lower lows. And the DXY was lower lows. Because the pound dollar is inversely correlated to DXY, when we're trading weakness, we're looking for GU to rise. And you can see it's clearly respecting that relationship right here. Whereas EURUSD was not. If you're positioned in a EURUSD trade, your upside potential is quite capped here. It's not breaking the high. Whereas GU, you would have been able to capture a much better movement in your favored direction. And that's all because we looked at EURGBP to get an idea of where it was likely to trade. The common traps really is treating the DXY as perfect. is useful, but it's not entirely the dollar. It can be weighted heavily towards certain currencies, especially the euro. So it's more as a filter, and it's not a perfect predictor, but if it does line up, it's a good indication that your trade is high probability and it's a good trade to take. And rates, they do matter, but they are not the only singular driver. There's a lot of things that go into the pricing of the dollar. Risk sentiment, growth, positioning, flows, news, they can all like be more dominant at different times. So just keep that in mind. The next trap is treating inverse DXY relationship as mechanical. GU and EU usually move inversely to the DXY because the dollar is the quote currency, but it's not always a perfect one-to-one relation. Sometimes it will lag behind, sometimes it'll be ahead. There will be periods where the pound or euro specific drivers, especially with news, will matter more. Next trap is confusing correlation with a trade. Just because things are related does not mean you have a setup. The relationship only gives you context. Your execution still needs its own rules. You still need your own framework and trading system for you to come out on top of the market with profit. The next trap is forcing a clean story when the market is actually mixed. Sometimes the yields, DXY, GU, EU, they're not telling you the same story. That is not something that you need to solve. That is not something you're doing wrong. That is just the reality of financial markets. And it is information. If you want to take a trade, it's not going to be clean. And if you don't want to take a trade and sit on your hands, there's nothing wrong with that either. It entirely depends on how you trade and what your preferences are. The main point is simple. GBPUSD is not just GBPUSD, and EURUSD is not just EURUSD. Every Forex pair is a relationship, and if you only look at one chart, you can easily mistake a dollar move for a sterling move, a euro move for a dollar move, or a weak pair for a strong setup. So my basic process is checking the rates and the yield backdrop, doing the main technical analysis on the DXY, using EURGBP to judge euro versus pound strength, choosing either GU or EU as the one that's going to best represent the DXY move and enables me to capture the most pips. Only then I start looking for the actual trade. It does not mean trading is easy, but it helps you to get a better grasp of the directional bias, whether to be bullish or bearish for the day, making sure you're not just taking wild guesses but actually cementing it in some fundamental reasons for the DXY to actually move in a certain direction.